Hi everyone, welcome back to our channel. Today we're diving into some serious economic news that could affect us all. Let's break down what they mean for the economy and for you. JPMorgan has raised the US recession risk to a staggering 60% following President Trump's recent tariffs, dubbed Liberation Day. Trump has introduced a 10% tariff on all imports, with even higher rates for countries running trade deficits with the US. JPMorgan is calling this the largest cumulative tax hike since 1968, equating it to a 22% tax increase overall. They warn that these tariffs could trigger a significant macroeconomic shock, potentially leading to a global recession, citing concerns over retaliation from other countries, declining business sentiment, and disruptions in supply chains. Now let's talk about how the markets reacted. Global stock markets took a hit as investors reacted to these tariff announcements. Japan's Nikkei 225 and South Korea's Kospi saw significant drops, while European indexes also fell. Wall Street had a mixed day. While the Dow and S&P 500 closed higher, the Nasdaq saw a slight decrease. Interestingly, gold prices surged to a record high as investors flocked to safe haven assets amid rising uncertainty. The Organization for Economic Cooperation and Development, or OECD, has also weighed in. They warn that increasing trade tensions and policy uncertainty could slow global economic growth. Their latest report projects a decrease in global GDP growth from 3.2% in 2024 to 3.0% by 2026. The US economy is expected to grow at just 1.6%, while China's growth could moderate to 4.4%. Rising tariffs and inflation are key factors threatening economic momentum, and the OECD is urging for greater international cooperation. Goldman Sachs has also adjusted its forecasts, now anticipating 3 interest rate cuts by the Federal Reserve in 2025. They have raised the recession probability to 35%, up from 20%. This shift is largely due to the expected impact of these higher tariffs. They project a rise in unemployment to 4.5% and an increase in core PCE inflation to 3.5%, while lowering GDP growth expectations to just 1.0%. Finally, let's look at the top 10 global corporations. They experienced a significant 13.2% decline in their combined market value in the first quarter of 2025, totaling $18.64 trillion. This marks the most substantial drop since June 2022. Companies like Tesla, Broadcom, and Nvidia saw major drops in their market capitalization, reflecting growing concerns over high valuations and uncertain profitability amid rising trade tensions. Let's take a look at the economic indicators for this week. Starting with the Chicago PMI, we saw a slight beat with an actual reading of 47.6 compared to the forecast of 45.5. While it's a positive surprise, it's still under 50, signaling contraction and continued weakness in manufacturing. The S&P Global Manufacturing PMI came in at 50.2, just over the expansion threshold and higher than expected. This return to growth reflects improving sentiment and could benefit materials and equipment industries. However, the ISM manufacturing PMI told a different story, slipping to 49.0, below forecast and in contraction territory. This could signal continued caution in capital investment, potentially impacting raw materials and logistics. Meanwhile, ISM manufacturing prices jumped to 69.4, up from 64.6. Rising input prices are a red flag for manufacturers as they face pressure on profit margins and higher costs across the supply chain. The JOLTS job openings dropped to a 7.57 million, suggesting a cooling in labor demand. This could reduce wage pressure, especially in sectors like retail and hospitality. On the trade front, the US trade deficit widened slightly to $122.7 billion. While negative for export-driven industries, this could also reflect strong domestic consumption. Initial jobless claims came in better than expected at 219,000, another sign of a strong labor market, supporting consumer spending and stability in sectors like housing and retail. S&P Global Services PMI came in at 54.4, another strong reading indicating healthy consumer demand. This benefits sectors like tourism, finance, and tech services. The ISM non-manufacturing PMI dipped to a 50.8, but remains in expansion. This shows resilience in the broader economy, especially for consumer and professional services. ISM non-manufacturing prices eased to 60.9, indicating lower price pressures. That's good news for inflation-sensitive industries like travel and food. Average hourly earnings rose by 0.2%, matching expectations. While growth is slowing slightly, it may help ease inflation concerns without significantly hurting consumer spending. The big headline, non-farm payrolls, surged to 228,000, far surpassing the forecast of 137,000. This robust hiring supports confidence in the broader economy and is a positive sign for real estate, banking, and consumer goods. The unemployment rate ticked up slightly to 4.2%, but remains stable. This suggests continued economic health and steady demand across most sectors. Next week, market attention will be focused on key economic indicators and earnings reports, including crude oil inventories, 10-year note auction, initial jobless claims, month-over-month PPI, and month-over-month core CPI. Meanwhile, several major corporations are set to release their earnings reports, including Delta Airlines, BlackRock Incorporated, JPMorgan Chase, Wells Fargo, Bank of New York Mellon, Progressive Corporation, Citigroup, Bank of America, Johnson & Johnson, and Morgan Stanley. So, while manufacturing still shows signs of weakness, services and the labor market remain solid. Overall, the US economy continues to walk a fine line between resilience and caution. What does all this mean for you? As these economic shifts unfold, it's crucial to stay informed and prepared. Make sure to like, subscribe, and hit that notification bell for more updates on the economy and how it affects your life. Thanks for watching, and we'll see you next time.